look at variance analysis, which is basically looking at how we compare our actual results to our standard results, or what we've budgeted. We're going to look at two costs, direct materials and direct labor. And if you recall, in direct materials, to get our standard, we had a price and a quantity. So we're going to have a price variance and a quantity variance. The direct materials price variance, you take your actual price, subtract your standard price, and multiply it times your actual quantity. And this shows you how much of the difference between your actual and your standard can be attributed to the price, to the difference in the price. The direct materials quantity variance, you take your actual quantity minus your standard quantity and multiply that times your standard price. And this will show you how much of your variance, the difference between standard and actual, how much of that can we attribute to our quantity. To get the total direct material variance, you add the price variance and quantity. To get direct labor variance is very similar. Instead of price and quantity, however, in direct labor, we have rate and time. So you're going to have a rate variance and a time variance. The direct labor rate variance is your actual rate minus your standard rate times your actual time. The direct labor time variance is your actual time minus your standard time times your standard rate. This is going to break it down and show you how much of that variance is because of the difference in rate and how much of that variance is because of the difference in time. And then to get your total direct labor variance, you're going to add your rate variance plus your time variance. Factory overhead variances, we have two. We're not going to spend much time on those. Your variable factory overhead costs can cause a variance that we consider the controllable variance, and your fixed factory overhead costs cause a variance that we would call the volume variance. If you recall, fixed cost, the more you manufacture, the lower your cost per unit. So if we operate at capacity, if our volume is high, that's going to lower our cost per unit. If we don't, we're going to have a variance. All variances are listed as either favorable or unfavorable depending on the effect on total cost. So for example, if our materials price was higher in actuality than what we had budgeted for, that would be an unfavorable variance. Or if we use more quantity in actuality than what we had budgeted for, that would be unfavorable. On the other hand, if it took less material than what we anticipated, that would be a favorable variance. Or if our price was lower. Same thing on direct labor. If we pay more per hour, that's unfavorable. If we pay less per hour, then that's a favorable rate variance. If it takes the workers longer to do the job, that's unfavorable. If they do it in less time, that's a favorable time variance. One thing about favorable and unfavorable, they're added together in the same way negative and positive numbers are. So for example, if you add a favorable variance plus a favorable variance, you're going to get a favorable total. If you add unfavorable plus unfavorable, you'll get unfavorable for your total. But if you add a favorable and an unfavorable, you're going to have to subtract the difference, the smaller number from the larger number, and the result would be either favorable or unfavorable, depending on the larger number. So let's look at a sample problem. For direct materials, we'll assume our actual was 12,000 pounds at $2.30 per pound, compared to a standard of 11,400 pounds at $2.20 per pound. And our direct labor, actual 1,600 hours at $22 per hour, compared to a standard of 1,400 hours at $23 per hour. When we look at the variances, we'll start with the direct materials. The price variance, you're going to take your actual price, which is $2.30, minus your standard price of $2.20, times your actual quantity of 12,000 pounds. And that gives you $1,200 in variance. Because the actual price was higher than the standard price, that variance is unfavorable. On your quantity variance, your actual variance is 12,000, your standard is 11,400. You multiply the difference between those two times the standard cost per pound of $2.20, and you get a variance of 1,320. Again, because your standard quantity was higher, because your actual quantity was higher than your standard quantity, that variance is unfavorable. Since we have two unfavorable variances, we can add the two together to get the total direct materials variance, which is 2520, unfavorable. Direct labor, the rate variance, we're going to take the actual rate, $22 per hour, minus the standard rate of $23 per hour, and multiply that times the actual time, 1,600 hours. That gives us a $1,600 variance. Because we were actually paying less per hour than what we budgeted, that's a favorable variance. Time variance, our actual time was 1,600 hours, our standard time was 1,400 hours, and our standard rate is $23 per hour. So 1,600 minus 1,400 times 23 gives us 4,600 for our variance. Because our actual time was more than our standard time, this would be an unfavorable variance. To get your total direct labor variance, because you have one favorable and one unfavorable, you're going to subtract the smaller from the larger and take the sign of the larger. So 4,600 minus 1,600, and that is an unfavorable variance. The reason you want to do these variances and break them down like this is because different areas have different responsibilities. So we want to know an explanation more than just that we added a variance in our total costs or even that we had a variance in our direct labor. We want to know specifically why did we have a variance. And in this case, we can see that the majority of the reason we had an unfavorable variance is because it just took longer to do it than we anticipated. This could be because we had new employees, because we can see that we've paid them less than what we anticipated paying. So that's what you can see when you look at variance analysis.